Welcome to the Strategic Treasurer Podcast, your source for interesting treasury news in your car, at the gym, or wherever you decide to tune in.
Managing bank relationships often look very different depending on the side of the table you are sitting on. Banks are quite formal in their approach to ensure a lasting multi-level institutional connection. Most treasurers lean towards the informal side of the spectrum of relationship management, categorizing their relationships in tiers. On this episode of the podcast, Craig Jeffery and Stephanie Villatoro of Strategic Treasurer examine the business of bank relationship management. Listen in on the discussion.
As we think about bank relationships and achieving a 360-degree view, I wanted to start off on how, thinking about the bank side, how do banks look at their clients? How do they view their clients? That could be eye-opening to some of those in the treasury world.
First and foremost is where do they see the value of each of their clients? One is just the longevity of a client relationship. Short-term clients obviously aren't going to bring in the revenue that's recurring over time with the amount of onset implementation cost. So longevity is one of the things that they look at for their clients and build that relationship with them. Another is just that comprehensive risk versus a reward assessment. So what is the risk of the client? What is the reward they're going to get from that? And that's typically what they call as RAROC. That's that risk-valued assessment on them, or the risk of the return. And another is, the annuity. I said longevity in the beginning. Annuity is another. It's that over time annuity of revenue coming in. That is their volumes of activity for a particular price of all their different bank relationship or bank services that they have with the bank.
Stephanie, thanks. So when you talked about longevity as one part about how banks see value, the longevity of services, can you also speak on the credit side and on the knowing the customer side, where the value is in the longevity of a relationship with an organization?
Yes, there's two ways to look at that. So there is the volume type transactional cost of setting something up. The credit side is also a risk to the bank as well. They're extending credit to a customer. They usually like a balanced approach there when they're looking and extending that credit, allowing them to have access to capital. They also like to have the other side to round out the relationship, both transactional services as well as the extending of the credit or capital.
And the risk-adjusted return on capital, it's interesting that banks are always formal in how they leverage their balance sheet for a client, what services they put to bear, and so mixing and balancing things up with fee income that provides a decent margin that may not put much capital at risk or the bank's balance sheet at risk is certainly viewed very highly by banks. I think the other thing, too, that idea of the comprehensive risk versus reward assessment or a risk-adjusted return on capital, showing that you have to have a higher level of return on a customer who might present more risk to the balance sheet of the bank. What are some of the ways that a corporation becomes more valuable to a bank?
We'll first start with the credit side. On the credit side, when you're looking at their return on their investment, a company that is cash flush and they're not drawing on their lines, that's less valuable to them on the credit side. And the banks kind of look at these in different buckets. So if they do draw on their lines, that becomes more valuable to the bank because they're paying higher cost using those capital lines. On the other side, on the flip side, flush cash, they have that sitting in the bank. The bank is, drawing interest on that. But it also has to do with the RAROC on the risk side. If a customer is more risky, so it's risk adjusted, they have different tiers of pricing on transactional cost. If you're a riskier client, they will also charge a premium for their services because of that risk adjusted return on capital there.
You started talking about the concept of managing the relationships from a risk side, but maybe we could get into the mechanics. And I don't know that every corporate understands all of the details and the formality that goes into managing these relationships on the bank side, and it's actually quite a bit different from what the corporates do, the corporate treasury groups do to manage their bank relationships. So maybe you could dive into what are the the mechanics, the operational things that go into a bank's management of a relationship?
There are several different ways that they do this, and corporates don't see the back office part of the bank side of how they manage them. And it's very interesting in that regard. So the first thing we'll talk about is call reports. So every time a bank meets with a client, every call, every meeting, and these are the more intensive meetings where they're talking more about the plans of the company. There's what they call an internal bank call report that they complete, that is processed with internally and kept track of, so they know what's in the horizon for each of their clients. That could be new banking services as a possibility, moving from paper to electronic, or maybe they're looking to extend credit down the road. So that call report is something that is looked at ongoing for the bank, of kind of like what's in queue for the future. And then they also have another connection, which is institution to institution. This isn't one bank to another bank, but different departments within the bank. So this could be your relationship manager to your credit manager. So there's multiple points of contact internally where they are discussing one client and the needs of those clients. And then another one, from that information from those 2 points, are the plans for the next year or two for the bank's top client. So what are the services that are going to be added? What are the new debt deals that might be out there? Are there clients of these top clients that need additional services like foreign exchange or expanding services, moving that paper to electronic, for example? So those are some different ways that banks manage those relationships. So Craig, I know you've worked for a couple of banks yourself. What do you see for those larger relationships, some of the things that banks view as most important for their long-term relationships, especially when they're leveraging that balance sheet?
I thought I was supposed to be doing the interviewing here. I'll talk more on the larger relationship side, the banks managing relationships with very small companies or those that are under 50 million. I think there's a different approach to those that are 200 million, multiple billions and up, because they're just a much larger relationship requiring more resources. When banks look at their corporate clients or corporate prospects that they're hoping to make clients, and they know they have to leverage their balance sheet in some way, and they have different platforms of services that they can offer. A couple things that they think about most thoughtfully and most regularly, one is accessing multiple parties at a corporation over time. This is that view of an institutional relationship. Like you had mentioned, inside the bank, they're talking to each other and looking at a relationship as a team. So too, the bank looks to establish relationships with multiple parties at any individual entity. They want to know the treasurer for sure, the CFO, the CEO, maybe heads of different business areas. So establishing multiple points of contact mean they have great access to what's going on, what are the plans, and it helps them establish continuity. If one person leaves, they still have a strong set of relationships. And banks take an institutional view. It's not a transactional only. They want to understand and have a relationship over time, and that requires, for the institution, requires multiple people, multiple individuals who can move in and out. So that's one. I think the second piece that's most important has to do with communication. And when I say communication, it's not just frequent communication. It's good communication, it's honest communication, it's providing the right type of information, sharing the plans that the organization has. Obviously, everything that can be shared that makes sense is useful to a bank. And as they think about what capital we may need to offer, what types of deals, a company's expanding into another country, they might need both FX transactions, they might need to support with hedging. Maybe their plans for growth are going to require access to the debt and capital markets, so they can be aware of and plan for that and act as an advisor on that standpoint, in addition to doing the particular deal when that comes up. So communication is the second one. The third, I would say, is very important, is the commitment to the bank. Just like corporations have a focus on their top tier banks who provide the most capital, who provide the most advice, the same thing holds true with banks. They're looking at certain customers that they're looking for a long relationship and a nice balance of services and credit. They are looking for people that will use them for advice, that will share and have open conversations and hold them to account, but also reward them for providing the type of advice, the type of capital that they need. Those are three things that seem to be most important for long-term relationships. There's certainly a handful of others. I don't know if you had any others that you wanted to bubble up to the top there, but those are three that seem most apparent to many different banks. So we talked about the bank side for a bit. How does the bank look at the corporations? How do they manage those relationships? What are their perspectives? So maybe we could jump onto the corporate side now. You spent a lot of your career on the corporate side of the desk as well as being on the bank side. When a corporate treasurer or someone in treasury is looking at their bank relationships, where do they see value, find value, look to get value from these relationships?
One of the bigger one is the access to credit. So we talked about that on the bank side, lending credit and giving that capital access to corporates. But that's one of the most important things for a treasurer. The reason behind that is they're responsible for the liquidity of the company, and having working capital access to funds is one of the most important things to have in place. Whether they're using it on a daily basis, a monthly, or more for acquisitions and things like that, that access to the debt and capital markets is key for a bank relationship, to be a key partner. Saying partner, that's really the next thing. That partnership with a bank to the corporate. They look to a bank as an extension of their department. Not necessarily internal, but that external partnership. Whether it's bringing ideas to the table for things that a treasurer is combating on issues or having problems with, or looking to enhance or become more efficient. Maybe they're forward-looking treasurers. Those ideas and that partnership is one of the key things. And that leads into advice as well. Advice from your banking partners on services, credit, debt, things that they have, for you, bringing that to the table on the forefront to make the treasurer's life easier or their department's life easier is one of the key things.
Everyone talks about the idea of the bank being a great partner, having access to a lot more clients, the business industry information, and they're in a unique position to be able to share some of that. What are those ideas that people are looking for? I know sometimes there's the question about how are other people doing something or handling something, and that could be operational or it could be very much business oriented or at a strategic level. How does that unfold?
Your relationship managers within the banking area obviously has access to a multitude of clients and other relationship managers with even a wider range of clients. Looking at whether it's industry specific or general treasury specific, they can lean on those other clients as well as looking at what's going on in the marketplace. One of the biggest things I see coming from a treasury group today, as well as when I was on the treasury side, is looking for more efficient ways to process your day-to-day operations. No one wants to come into work and do data entry anymore. Treasurers are looking to be more strategic, so they're looking for ideas to make their areas more straight through processing, so they can focus on the more strategic things that are coming down from the CFO or the CEO. And that could be automation on a treasury management system, automation for bank fee analysis. Those are just a few ideas on the operation side.
So someone, the operational manager in treasury may love that. Their goal is to reduce errors and more fully automating things, understanding leading practices there. What about the assistant treasurer who's trying to support growth into maybe a region of the world they've not been in before, new countries, or they're taking on a new line of business that didn't exist previously? What exists there for banks to help corporates on the advisory side?
On the advisory side, they have access to a lot of different expertise within the regions. So one of the things I utilized going into new markets in the Asia-Pac region was utilizing a bank expert on those regions, what to expect in each of the countries, what do we need to do for putting in working capital credit lines to opening bank accounts, getting government approval for foreign exchange accounts. Those are the type of things that we leaned on them, our banking partners, in order to assist us on a smooth transition in those countries, opening up practically new businesses from scratch. So in those areas, they become more of that extension of your department of just advising you on what to expect in those areas.
Excellent. We won't jump into the advice they can provide on accessing the debt and capital markets and what's going on pricing and availability. I think that's probably pretty well understood, or would be a little bit of a discursus for that. How formal are corporate treasurers in terms of how they do their bank relationship management?
This ranges, obviously, from company to company, and I think it really depends on the maturity of the Treasury group. So from that perspective, sometimes you have an individual view from the treasurer's relationship with a banking partner, and they are the only point of contact there. That tends to be with those smaller type of companies that have that one-on-one relationship where the treasurer is managing a lot of the not only operational but more of that strategic view. Then there's also that institutional view that's internal of an organization as they grow. The CFO, the CEO, the treasurer, the assistant treasurer all have different levels and different access to within the banking group. So you may have an RM that meets regularly with the treasurer. Once in a while, we'll also meet with the assistant treasurer or the CFO. But then you also have those debt and capital markets relationships as well within the bank with the company. So you have different, depending on the size and life cycle of the Treasury group, depends on how they're going to view their bank and have that relationship work.
So in terms of expanding beyond the view to what the plan is, are corporations creating a written plan for what they want to do with relationships? Do they have a bank relationship plan policy or bank relationship policy? How formal are things? How informal? What are some of your thoughts there?
Again, I think that has a range, but those that are more formal in planning versus non-formal, they basically do the same thing, just some may be more formal in that regard of tiering their banks, looking at maybe even a share of wallet where they rank each bank in a tiered fashion of what services they have, which banks are, issuing credit or extending credit, especially if they have a syndicate loan. Those are the different types of ways they can tier them, as well as have a balanced scorecard approach. If a company's policy from a banking standpoint is to provide those that provide credit to them, they extend services to them as a kind of a thank you, where they get more business. They can have that share of wallet. That way, when they have those relationship calls with the bank and the bank is calling on them to try to extend more services, they can say, hey, you actually have the majority of our services, or yes, we're trying to, build that up on your side, and here are some ways that we're looking at this, and they can have that conversation.
So you mentioned share of wallet. Why don't you define what that is for the audience?
So a share of wallet is a methodical way of viewing your banks based on credit offering and the services that they supply you. So it's looking at how much business you're giving them and what they're extending to you. So if a bank is your lead in your syndicate loan, they're offering you the majority of the syndicate, as well as they may be your main concentration bank. They become that tier 1 type of bank, and they have plenty of services. Someone else may be up and coming. They've entered into your credit facility, but they yet don't have any cash management services. So from a share of wallet perspective, you're going to look at trying to award them some type of business and how you can methodically move things around to provide that share of wallet to a new credit bank.
This is almost like reverse engineering the Ray Rock, right? This is a company looking and saying, what credit's provided, what's that worth to the bank, what are the services we're getting, how am I balancing that out so that I'm important to the banks that are important to me, or that I want to be important to our company, our organization going forward. Is that a fair way to characterize that?
It is, and it's also the beginning of looking at your counterparty risk, but I know we're not talking about that today. So it's looking at where you have services with different banking partners and how much of what service they have as well.
Yeah, counterparty risk. I think that the other item, I know you and I have talked about this and worked with a number of clients on this, is when you're trying to rebalance the share of wallet someone's providing, a bank, you want to be much more important to you and make sure you maintain the importance that you have for them and them with you, is making sure that you can allocate services. You don't just want to throw services. You want to put services and activities that they're best suited to deliver. So you're not just feeding the relationship, but you're being effective and making sure you're getting the right types of services.
Yes, you're right. That balanced approach. You're not necessarily going to award just best of breed because you have other, partners that you look at as truly a partner that are providing services to you. So you can look at best of breed within those.
Yeah, you also mentioned balance scorecard, and I thought we could just dive into that a little bit more. What does it mean? You mentioned services, service level, services. You want to just describe what a balance scorecard is?
A scorecard is exactly what it kind of says. This is a scorecard. You're rating your bank based on your relationship with them. How often do they call upon you? Are they, responding to your inquiries or your requests or issues in a timely manner? You rate them based on that. So that balanced scorecard approach is a way for you to give feedback to your bank from a corporate perspective. How are their customer service lines doing? How is the relationship manager doing? How is the credit facility area doing, or that management team as well? So it's a balanced approach to look at a two-way relationship.
So this obviously includes the different areas that are getting services from card programs, from cash management, as well as the service and ideas that they're providing to Treasury. From a recent survey on Treasury perspectives, we saw that 24% of corporations in the survey used a balanced scorecard approach. So slightly less than 1 in 4. Call reports, we talked about call reports from banks. Banks are very formal in doing that. You have to fill those out. It's a natural discipline. Only 12% of companies document the meetings they have with banks in a formal call report that's available to maybe core treasury or to those that are on the relationship standpoint. That's 1/8 of companies are formal in that way, where it's almost universal that every call is documented on the bank side. Is that an interesting distinction? Do you think there's an opportunity there?
There's always opportunity on the Treasury side to do things more effectively on the bank scorecard side as well as with call reports. But I think time and balancing, tasks on a daily basis of what's critical versus not critical, these things tend to fall in the less critical area unless you're having an issue with a bank. And if you're having an issue with a banking partner, you tend to want to score them to give them feedback on where they're not doing well. It's kind of like the whole payroll. If you get paid on time, payroll never hears about it. But if they miss your payroll by 24 hours, everyone's screaming. So it's kind of the same here. And that's why we're seeing those lower percentages.
And they'll hear about it for years to come, about that 24-hour gap. The other area in evaluating and planning, we spoke a little bit about multiple levels of relationship or multiple parties at a company, connecting to multiple parties at a bank from an institution to corporate perspective. Some CFOs, some CEOs may not want to be bothered with having these meetings with some of the top banks, so they want to really limit that involvement because they're extremely busy, and that's something that the treasurer should do, or at least that's the perspective. How do you see treasurers being effective in making sure that there are opportunities for connection points, not a monthly meeting, but time for senior members of the bank to meet with senior leaders of an organization?
I'll pull upon some of my corporate practitioner experience here of how that can be done. Working with a financial services company that had high volumes with the bank, there was a lot of access to the CEO and CFO level based on partnerships with different banking partners. There were multiple tiers of levels there, as well as on the negotiation side for just bank services because of those high volumes. So from that, I saw, that access from that standpoint, where they're key, important, critical factors for the ongoing sustainability of a company from a bank relationship standpoint, where that was pulled from. And key partners were very strategic in that regard from the top level bank and the top level of the company. For companies that do not have those high demands on a financial institution for your basic operations, it's more just treasury operations, that can be a little more challenging to get the CEO and CFO involved or someone else from the executive committee to have those meetings. But I think at least biannually or annually, those need to be completed with your top tier banks. So those that are most critical to the company.
Yeah, the other thing that we've seen, and I participated in on the corporate side of the desk, with larger organizations, some of the much larger organizations, there'd be a lot of key relationships you needed to maintain, feed, and communicate with. And it's hard to get access to the CEO, the president, and heads of major lines of business multiple times a year. So I know some of the large organizations take advantage of and set up banker meetings where they will bring their bankers in for a day or 2 days, have some social event associated with it. They cover the business, the plans. There's times to ask questions, to build rapport and build relationships. And those are some ways that people take advantage of being efficient, getting people together and making those connections. Stephanie, just in terms of reflecting on this 360-degree view, the bank side, the bank view, the corporate view of relationships, there's certainly some differences here and some similarities in terms of goals. What would you say we can learn from understanding the different perspectives?
From the different perspectives, I think if corporates were to view their banks the same way banks viewed them, we'd have more of a balanced relationship within relationships between a banking partner and a corporate partner, where they would lean on their banking partners more, as well as have a keener understanding of the needs of a corporate. So if that communication was the scorecards and the call reports were all mutual between the two, it would make it more seamless, I should say, where you're not having to reach out to your banks to say, hey, this is coming up and I need this, or we've needed this for a while. It would be more proactive is what I would see. But given the fact that corporate treasury departments are always in the here and now of what is most critical, it's a little much more difficult for them to do that.
I like that. I like the way you explain that. It made me think of, as we're just reflecting on this in this podcast, it's, banks are in the business of banking, and therefore bank relationships are their core business, and so they're very formal about it. Corporations and organizations are in some other business, but there is a part that Treasury is in the business of securing the capital, the services, the resources that are needed. And I think what we've seen from surveys, statistics, there is an opportunity for many organizations to be both effective but more formal in managing those relationships. Stephanie, I want to thank you for taking time on this podcast to share your thoughts on achieving a 360-degree view of bank relationships.
You're welcome, Craig. Thank you very much for today.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, Visit and bookmark strategictreasurer.com.